Now in the US, falling oil prices have landed a major hit on the states most dependent on the natural resource. Texas, Oklahoma and Louisiana are bracing for a surge in unemployment as oil companies there prepare for budget cuts and also massive layoffs. RT's Gian Chikian looks at the issue.
States in the U.S. that depend on the oil and gas revenue brace themselves for the snowballing decline in oil prices. U.S. energy companies have begun to cut drilling, lay off workers and slash spending. Texas has already lost 2,300 oil and gas jobs during October and November, according to the Federal Bureau of Labor Statistics, and more cuts are expected next year. Economists say companies providing support services to oil and gas companies could cut 40,000 jobs by the end of 2015 if oil stays at around $56 per barrel. But it's not only those in the oil industry that would suffer. Energy investment strategist Marin Katusa is with me today. If the oil price stays low for a few years, how is this going to affect alternative sources of energy? I mean, they've been having a hard time already.
Definitely in the U.S. sector, without the government subsidies in America, most of the green energy, whether you talk at the solar, wind, the technology is not cost efficient yet without the government subsidies. So you'll see a lot of the money coming into that sector go away because it's a risk-off market. So the low oil prices will also affect the green energy sector in the U.S. also.
How is this going to affect the fracking industry? Because it has largely been behind the energy boom in the U.S.
Well, you see, since 2008, the U.S. domestic shale sector has increased their debt on the corporate levels by $150 billion. So there's a lot, because there's so much cheap money, you know, a big effect of QE was coming into the shale sector because people were chasing yield. So a lot of this cheap money came in, the technology, the exploration came in. So the question is, how's this debt going to be rolled over? At $45, you can't finance that debt. There's going to be a lot of defaults. What about the trigger effect, the derivative effects? This spillover could be a domino, and it's very, very bad news. This is like the black swan that no one's talking about in the U.S. sector, in the economy.